A startup demands much more than just a great idea. It demands a lot of time, discipline, dedication, and most importantly, funding. First Round Capital is a venture capital firm that often invests in pre-revenue and previously unfunded companies. Today, we will check out everything about First Round Capital. Before starting the video, please subscribe to the channel and click on the notification icon so you get notified when we upload the next video. 6. First Round Capital Teardown. First Round Capital is famous as a choice investor for early-stage firms. Founded in 2004, First Round Capital has quickly become an eminent venture capital firm by spotting future unicorns such as Uber, Square, and Blue Apron. A key factor in their success is in their post-investment support system, through which founders and companies are assisted frequently by first-round partners and each other to pool talent recruitment and generally solve problems that assist company growth. Coupled with programs that specifically target early-stage startups, such as the Dorm Room Fund aimed at entrepreneurs in college, FRC has made a name for itself as a well-known investor for growing startups. Using CB Insights, we took a fresh look at First Round Capital's investment strategy and exit history. Notes: where's the data and viz from? 100% of the visualizations and data you see in this teardown are directly from the CB Insights platform's investor analytics tool. What's a teardown? A product teardown is the act of disassembling a product to understand its parts, functionality, etc. An investor teardown is analogous. We're trying to understand a firm and what makes it tick by analyzing data around their financing strategy, investment thesis, key people, exit history, investment syndicates, and more. We'll discuss trends and highlights in First Round Capital's portfolio over the past few years by analyzing the following dimensions: financing activity, deal size, exit activity, notable partners, industry heat map, geography heat map, financing by stage, new versus follow-on investments, investment syndicates, fund size. 5. What is the first round of funding for a startup? When the startup decides to raise funds from the public, including institutional investors as well as individuals, by selling its shares, it is known as an IPO, initial public offering. IPO is commonly related to going public, as the general public now wants to invest in your company by buying shares. There's no obligation for the founders to disclose their financial statements before going public if they go for an IPO, but the company must submit information related to financial statements, the purpose of raising funds, etc., to the SEBI. IPO basically helps you grow and diversify in areas of choice. For taking your startup to the next level, you should know which stage of funding you want to go for what purpose. Such decisions made at the right time can be a boon for your business. IPO is the process of offering corporate shares to the general public for the first time. Growing startups that need funding often use this process to generate funds, whereas established organizations use it to allow startup owners to exit some or all of their ownership by selling the shares to the general public. When a startup decides to go public, a specific set of events occur during the IPO process. They include formation of an external public offering team comprising of underwriters, lawyers, certified public accountants, and SEC experts. Compilation of the startup's information, including its financial performance, as well as its expected future operations. Audit of the startup's financial statements takes place, which generates an opinion about its public offering. The startup files its prospectus with the SEC and determines a specific date for going public. Raising funds for the startup is not the only benefit that entrepreneurs enjoy in case of a public offering. Some other advantages are: a public organization is able to generate additional funds through secondary offerings as it already has access to public markets. Many public organizations compensate executives through stock. The stocks of a public organization are more attractive to employees as the stocks can be sold easily. Also, being public allows an organization to recruit better talent as well. Mergers are easier for a public organization as it can utilize its public shares to acquire another startup. 4. Different stages of startup funding. Every startup, irrespective of the nature and size of operations, requires funds to convert its innovative ideas into reality. Most of the businesses generally fail because of their inability to raise sufficient funds. After all, you need some money or capital to keep your business going at every stage. If you are new to the world of startups and have no idea about raising funds, then you need to make yourself familiar with these different stages first. Self-funding. An entrepreneur should ascertain how much amount he or she can contribute from his or her own pockets. Assess all of your investments and savings kept in multiple accounts, and approach your friends and family. This stage involves fewer complexities and documentations, and even your friends and family may be ready to lend at a cheaper rate. Self-funding or bootstrapping is apt if your startup requires a little investment earlier. Seed capital. Seed capital is an investment made at the preliminary stage of the startup. This helps the business in identifying and creating a perfect direction for their startup. Funds raised at this stage are used for knowing the customer's demands, preferences, and tastes, and when formulating a product or service accordingly. Most of the budding entrepreneurs raise this capital from friends, mentors, and family, while some take up loans in exchange for common stock. Venture. When the company's final products or services reach the market, venture capital funding comes into the picture. Regardless of the product's profitability, every business considers using this stage that further involves multiple rounds of funding. Series A. Series A investment, being the very first round of funding, doesn't ask for external funding. At this stage, startups have formulated a specific plan for their product or service. It is mostly used for marketing and improving their brand credibility, tapping new markets, and helping the business grow. Series B. When a business relies on Series B investment, it portrays that the product is marketed right and the customers are actually buying the product or service, as decided earlier. Such funding helps a business pay salaries, hiring more staff, improving the infrastructure, and establishing it as a global player. Series C. A startup can receive as many rounds of investment as possible. There is no certain restriction on it. However, during Series C investment, the owners as well as the investors are pretty cautious about funding this round. The more the investment rounds, the more release of the business's equity. Series D funding stage and beyond. Not many startups find the need to go to this stage. The Series D funding stage allows entrepreneurs to raise funds for a special situation, for instance, a merger, and also if it has not yet hit its growth goal. A startup may consider Series D funding if it hasn't gone public yet, but is contemplating a merger with a competitor on agreeable terms. The Series D funding offers startups the most viable solutions, allowing them to negotiate issues head-on by acquiring another startup as a merger. Also, if a startup is unable to achieve its growth landmark with Series C funds, then it will find the need to get more funds through Series D funding to keep afloat. 3. New versus follow-on investments. Almost all of FRC's new investments are at the seed or Series A stage, in alignment with their strategy of being a company's first institutional investor. However, unlike other seed investment firms, first-round capital prefers to continue investing in companies after initial funding, resulting in slightly more follow-on deals in most years. Note the consistency of their investment trends, which aligns with their view of keeping a consistent broad investment strategy across business cycles, i.e., not growing fund sizes or speeding up investment pace depending on supply of capital. In addition, Q3 of 2015 was a notable outlier with the lowest percentage of new deals closed, at around 20%. As previously mentioned, that quarter marked a slowdown of deal activity on the heels of FRC's LP letter expressing concern over the ramp-up in valuations. The chart below from CBI's Investor Analytics shows the proportion of first-round capital's new investments versus follow-on investments in each quarter for the past 5 years. 2. Fund size. First Round Capital is currently investing out of its fifth fund worth $175 million. FRC has continuously raised funds between $100 million and $200 million, keeping fund size consistent over time. While this is a substantial sum for seed-stage investor, it is in tune with first-round strategy of participating in follow-on deals at Series A and beyond. Apart from their main fund, FRC also raised a separate $3 million fund as part of their Dorm Room Fund, to be managed by university students primarily for on-campus ventures. DRF generally invests in very early seed-stage companies through a $20,000 convertible note that converts into equity in a later funding round. By being able to invest in newer companies while delaying valuation concerns, DRF ties in with FRC's positioning to be a startup's first major investor. 1. In a nutshell, the various startup stages allows entrepreneurs to scale their startup at any stage of their entrepreneurial journey. This scaling practice allows them to identify where their startup stands and which potential investors would invest in them in order to help them grow. Do remember that in order to gain funding, startups must be mature enough to qualify for a specific funding round. You can identify where your startup stands by its net worth. Many amongst them also prefer becoming an angel investor themselves and invest their hard-earned money into other startups. After all, they've certainly earned the right to relax and advise other entrepreneurs on how to grow their startup and make it profitable. Do share with us in the comments if you know more about First Round Capital. Thanks for watching.